If you want to buy a house and get a normal mortgage, as they would say, you can use your crypto. Get her started.
Get her started. This is the most current recording of We Pitched Real Estate. Today we're going to have a conversation about crypto and mortgages, a brand new mortgage product that you might be interested in. And stick around because we'll be talking about buyer disclosures.
We talk a lot about real estate, but we also do mortgages. And I wanted to get into some stuff, explain some things that maybe people don't know about. So a whole bunch of you are sitting with Coinbase or a Robinhood account with crypto and this coin and that coin. And we will not go into if it's real or not, and that's for you to decide. But if you want to buy a house and get a normal mortgage, as they would say, you can use your crypto. But, okay, the bank will still do a trailing of funds. So you need to give them the last 2 months statements from, let's use Robinhood as the example. Mm-hmm. But what you must do for them to count it for you to actually use is to convert it to cash. It's got to be USD. So the idea is right when you apply for a mortgage, sell the crypto, put it in your bank and show the transfer. You'll be able to show the transfer. Let's say your bank is Chase. So you got 2 months of Robinhood, you give them 2 months of Chase and they see Robinhood out 10,000, Chase in 10,000 from Robinhood. So every mortgage goes through what's called an audit trail of all your funds. So I've said this before, don't put any large deposits into your bank account that you can't prove, like pile of cash from your lottery winnings or something or whatever. So it's very important to document it that way. Check with each lender because they can have their little nuances. You can do a margin loan against your crypto, but when you do, again, you have to transfer it into your regular account and have it be USD.
But there is the 120% rule that you can use leverage of crypto without having to liquidate it.
Yeah, and let me read this right from the guidelines so we get started. If it's the 120% rule, if retirement assets plus stocks, bonds, mutual funds, and crypto equal 120% or more of remaining funds needed to close, no liquidation is required. No proof of liquidation is required. If assets fall below the 120% threshold, funds must be liquidated, deposited into a checking and savings, and fully documented. Why this matters to buyers? Because a strong balance sheet gets flexibility. The rewards asset diversification, not just cash-heavy borrowers. It's a big deal for crypto-native clients who don't want forced liquidation unless absolutely necessary. Because, hey, there's some crypto you don't want to sell.
Yeah, you don't want to pay capital gains on it.
That's the other issue you have with this. So you can do the margin loans, take that margin money, what you've borrowed basically, and transfer that to USD so they count it. Remember, you have to have that debt counted against you in the margin loan. And there's all different ways to do that. I won't go into those details, but ask your lender if you're going to do that. So the bottom line is, the easy way, sell the crypto, put it in the bank. If you have the 120% situation, like I explained, then you don't have to do the liquidation. And if you do the margin, then you obviously don't have to liquidate, but you still have to have that margin loan counted against you as a loan and a monthly payment per se. Even though you don't really have it, you just got to pay it back. It might get called and whatever happens. So, but don't be scared if you have crypto, but talk to the loan officer, ask them to get the company's guidelines, copy and pasted and sent to you. Because the loan officer might miss something, or it might be a loan officer who's great, but just doesn't understand crypto. They've never had anybody do it, So that's what you want to do. Get a copy of the actual guidelines, so you know exactly what you're doing and do it right.
That's interesting. Yeah, and that's good for borrowing. Now, I don't know the answer to this, but say you bought Bitcoin back in 2015, and you now want to just settle the transaction in Bitcoin. Would this save you on the capital gains?
It's got nothing to do with the capital gains. What you do with the money has nothing to do with it, unless you do the margin loan.
You'd never sell the Bitcoin. You're just basically transferring the Bitcoin to settle the transaction.
So the way the incredibly wealthy don't have no income on their income taxes because they borrow against their assets. So if you had $1 billion cash in the bank and you only needed 200 million to live every year, you give your $1 billion as collateral to the bank and say, I want to borrow 200 million, and they'll give it to you at prime or prime -1 because you're a great customer. And then they live off of that borrowed money. This is the same exact thing, but you're borrowing it and then buying a house with that borrowed money.
I see.
Okay, so borrowed money is not taxable. Capital gains, when you sell, that's taxable.
I see.
All right, so that's how Bezos and everybody else doesn't pay any income tax. So that's why California was talking, at least one of the unions is trying to push this so that there's an asset tax. That's why one of the original discoverers of Google, Larry Page, he's building a whole bunch of houses in Florida because there's no state income tax and they're not going to have this giant tax against it. He's prepared just in case this passes. It's not going to pass. Things are going to get modified a little differently, I'm sure, in some way, shape, or form. But yeah, we're not a political podcast, so we're not going to get all into it, but just keep an eye on it if you're a gazillionaire. It's my, Larry, keep an eye on it.
That's interesting. So what's your advice though on
to borrow or not?
Do you know of a particular mortgage product or stuff that you can use this with, or is it just something you got to
you can use it for any product?
Oh, you can. Okay.
Yeah. This is standard guidelines. What I just told you is Fannie Mae guidelines.
Oh, okay.
So it's Fannie, Freddie. There's a little tweak for FHA, not a big deal. VA, you can do it. And the jumbos from the banks, they all have their own rules, but pretty much they're going to follow Fannie rule on this. As long as they can audit funds, it's fine.
And previously there wasn't a conduit. There wasn't a way to show this like chain of transactions. So suddenly there's just like 100,000 shows up in your account and you say, well, it's from a crypto exchange. They're like, well, that doesn't count. Is that this?
Well, I mean, they didn't know what to do with it.
Okay. Before. So this kind of finalized or sediments it.
Yeah, exactly. So it makes sense what they're doing. Mm-hmm. So bottom line is don't worry about it. That's awesome. Good news.
That's great. So you've got the funds, you've got the lending. Let's talk about this new mortgage product.
Okay. So what is the opposite of a 30-year fix? Is a 1-month adjustable, right? What I'm going to talk about is actually a loan that can change. Oh, let me preface this is one other important thing. You know how we talk about the prime rate has nothing to do with mortgages? Well, it has nothing to do with the 30-year fixed mortgage. The Fed funds rate, which is what the Fed controls, the word Fed funds rate, okay, get it? That's the place, and that's the rate that they charge member banks, which is all of them, pretty much, to borrow money from the Fed that they can reuse. So if the Fed funds is at 3, I don't know what it is. I'm just making this number up. Let's say Chase borrows at 3% and they decide their prime rate is 5. So if they offer you a loan at 5, they make the spread of 2% over the Fed funds rate, which is what it costs them. So that's the simple arithmetic of this. Now, if you do a vanilla 30-year fix, you're going to get, I don't know, 5.875, no points, APR 5.902. I don't know, making these numbers up. But
you can find them live online at Arrivva.com.
Arrivva.com/rates. Yeah, exactly. Based on your scenario, and you can get updates anytime. So you will have a rate that is fixed with a 30-year amortization. So you're going to be paying principal back. Very small amounts in the beginning because you're paying back interest based on the amount that you actually owe. So that's always going to be higher. It's simple arithmetic. But the flip side of that is there's a new loan that's coming out, or it's out. If you're putting 25% down, you have a 680 credit score. You're buying a primary residence, a second home, an investment property. You can use it for a purchase, a rate and term refi, cash out refi. They will do loan amounts up to $3 million and debt to income ratio up to 50%. So that's higher than the alleged 43% that Fannie Mae has, but really Fannie Mae goes higher than that. They just don't tell anybody. You can document your income with full doc, pay stubs, W-2s, 12 or 24 months bank statements, 1099 income is allowed, asset depletion income is permitted, which means you have like a retirement fund that you're taking down every month that they can prove, and they use that as income. So it is a 30-year variable term, meaning every time the Fed funds rate changes and the prime rate changes, you're going to go up or down. For the first 3 years, you can draw on the money. What does that mean? Say you did this as a refinance. You got $1 million house, you got a 750 mortgage. You got a 750 line of credit. It's what it is. But you only take 200,000 of that to use. This is great for somebody, with tons of equity that just wants to redo their house, and they do a little bit at a time. So they're only paying interest on the outstanding principal balance. But you're only allowed to do that for 3 years. And then you have to pay it off in 27 years, whatever's left. There's a 27-year amortization. There is no prepayment penalties on this loan. So the idea is if rates are on their way down, which it sort of kind of looks like, it's not as clear as a bell as it was. I actually listened to Chairman Powell yesterday. The guy's so good. He's just so good. Anyway, so if you think it's going down, this allows you to make payments based on interest-only payments. So you're not paying any principal back. The rates, they're kind of all over the place depending on the loan to value, the credit score. It's prime plus something, prime plus 1, prime plus 2, whatever that comes out to be. But even if it's a little higher rate than what the 30-year is, you're paying only the interest, which is usually tax deductible. So the idea is with no prepayment penalty on this and 3 years to draw the money. And if you do it for a sale, you obviously are going to take all of it. At the end of when the rates are coming down and you think they're going to go back up, that's when you refinance. So you've had this low payment of interest only for a while. Or this is good for somebody who thinks they're going to, get a really big bonus and pay their loan down in a short period of time. So there's investors should love this type of loan, get some cash flow for a few years. You can refinance into the same product and get another 3 years out of it. So it's really interesting. It's not for everybody, obviously, but if you think about it and you're in that kind of situation, it's pretty good.
Yeah. And given the documentation of what you need, I can see this would be really perfect for self-employed people.
Yeah. You're going to, especially if you have lulls in the year, if your busiest season is Christmas and then, the middle of the summer, you don't do anything, this kind of makes your payment a little lower. You can pay it down. There's so many different scenarios that this works for. But the fact is you can do it as a first mortgage. That's the really interesting part of this, because usually these are, HELOCs. Everybody knows the word HELOCs, home equity line of credit. That's all this is. But they're usually a second mortgage. But this product offers being a first mortgage. So it's really interesting. Yeah. So you can't go to arriva.com/rates to find out these rates because it's not part of the pricing engine. But you can ping us and we can go over your scenario and tell you what it is, what the payment would be, and all that kind of good stuff.
So this is almost like a hybrid, mortgage, kind of crossing lines between a regular one and a HELOC.
No, this is a HELOC.
It is a HELOC, but it's got some regular mortgage qualities, such as it can be your primary.
Yeah, but so can a HELOC. So, you're kind of going off the reservation a little bit.
The questions
it's just the antithesis alternative to a vanilla 30-year fix, and it might work for you. Depends on your situation. Just bring it up because I saw it because it's a first mortgage product, which I thought was really interesting.
Yeah. Are there any greater risks that you see from like a standard HELOC?
Yeah.
It's just the same.
Yeah. And they're going to take, all the weird documentation, the 12 or 24-month bank statement. So that kind of stuff is pretty cool. A product like this.
That's good.
So,
it feels like it fits your needs. Give Arriva a call. Talk to Fred. He'll help you find the best product.
And MLS number 133975.
Yes. Always check that.
California DRE number 015071615.
Let's shift the topic away from mortgages. Now you've got your fully underwritten pre-approval. You've got a good idea of the type of mortgage you're looking for. You've got the chain of custody for crypto. So you're all set. Now it's time to go look and buy and sell a home. Let's talk about buyer inspections and disclosure duties, specifically in California.
Okay, here's the deal, kiddies. Let's say you're buying in Southern California, where they do not do inspections ahead of time. And don't get me started on that. Because it's a second negotiation with the seller. Because you see the pretty house, it looks nice. Then the inspector comes out who gets underneath and finds the ugly. And so I had a case of that the other day, and I've had, this comes up every once in a while where we get the report and we also price out what the repairs are going to cost. And let's say it's $150,000 worth of stuff.
Mm-hmm.
And even if we get estimates from contractors or through AI or a combination of the both, all this comes out. So the seller, we send this request to the seller. It's like, we lower the price or give us credit or a combination. By the way, there's limits on credits if you're getting a mortgage. The credit can only be for when you're doing a mortgage up to X percent. And I say X because it depends on your down payment. If you're doing a conventional loan with up to 9.9% down payment, you're only allowed 3% of the sale price as a credit. After that, it's 6. At 75%, it's 9. The VA's 6%, FHA's 6%. So everything's a little different, but it must be no higher than the actual closing costs themselves. So 6% sounds great. Oh, I'll take a 6% credit. Your closing costs ended up being 3.2% of the sale price. That's all the credit you're going to get. So to get the rest of the money, you're going to have to lower the sale price, which kind of is not as good, especially if you're financing 90, 95%. You're going to have to come up with more money because getting the credit is dollar for dollar. Lowering the sale price, it's like you're 5% or 10% down is lessening by a little. So that's the things to watch out for. But anyway, once we send the request for repairs or credits or whatever you send to the seller's agent, the seller's agent now has all the documentation and knows about it. They can't hide it. which means, and this is the leverage for you to get a seller to do something is, look, you now know about all these problems with the house because here's the inspections.
Mm-hmm.
You are obligated now to disclose that to the next buyer. Let's talk practical. Practical of that in Southern California is they don't give out inspections or disclosures to anyone until after they sign a contract. So you're going to see this pretty house again, and you're going to sign the contract. Then you're going to get the disclosures in what's called the SPQ and the TDS, where the seller has to say everything wrong with the property and the area and whatever they know. If they don't disclose everything that the previous buyer's inspections had on them, they're in violation. They're in double secret doo-doo.
What happens when that happens?
They can get in trouble with the DRE. They can, if the contract is completed and they find all this stuff out that maybe their inspector didn't find out, but the seller knew about it, it's time to call a lawyer.
Yeah.
And possibly do something. But it just gets messy. And, that's why we make sure, and Southern California property owners, please listen. We order and pay for all the inspections when we list your property. So you know what's wrong. No one else is going to do another inspection. You can fully disclose it, and then you only negotiate once. Maybe you adjust your price right away and you attract more buyers because of it. You're giving them transparency.
Because you know the inspection is going to happen anyways.
Exactly. So what's the point of hiding it for a while? Keeping them in because they're emotionally tied to a property? That's bunk. People are not that, I'll just take it. I don't care what's wrong with it. It just doesn't happen. So this is what happens in Southern California. Add to that the escrow companies who are charging outrageous fees and coming up with their own. I had one escrow company that decided to do a contract change and let the buyer and seller sign it without me even knowing about it. This is an old school thing with these escrow companies. They think they're in charge of the transaction, once it gets to them, but they're not. The Department of Real Estate says buyer has an agent, seller has an agent. They prepare the documents. They get them signed. They get them approved. I never have this problem in Northern California. The title companies who do the escrows for us charge less, don't get involved in the transaction like this, and we're doing what we're supposed to do. We don't need their help, but they get all flustered and pissed off if I point that out to them. It's, I had another one that said, if you don't close, there's going to be a per diem. That's not in our contract. So why would I
per diem for what?
If you're late on the contract? That's not in the contract between buyer and seller. The escrow company put that in. It's like, what? What are you talking about? So
yeah, it's unrelated, but I have to say, when you said old school, I immediately thought of every escrow company's logo. They all look like they from 1890.
Oh, and they all put like artwork, a GIF in there of their name and their logo and their phone numbers and their email addresses and their websites, which aren't linkable because it's in a picture.
And then after like 3 exchanges, you've got 25 logos.
It's like, that's not going to get you any more business. Just put in a regular signature. Okay. Just type it in like everybody else does. I mean,
we digress.
Exactly.
So I have a question. So on the seller, you're selling your home, you do the disclosures before it goes to market. Well, it comes back with some pretty interesting stuff. Can the seller remedy that situation and add it to the?
Absolutely. I've had sellers, once we did the inspection, they literally went through everything, did absolutely everything. So we mark up the inspection report, completed. We put that in the SPQ, the TDS, whatever was done, that we had this problem, but we repaired it. Here's a copy of the bill. The more you do as a seller and the more more devoted you are to making sure everything is right, the more money you're going to get for your property, period. Because, hey, buyer doesn't have to worry. Same thing when you're submitting an offer in reverse. You waive the inspections, you waive the mortgage, you waive the appraisal, you close in 15 days. And then the seller doesn't have to worry. Everything's done.
Mm-hmm.
Here it's the flip side. The buyer doesn't have to worry because everything's done. Everything's repaired. It's a beautiful thing.
And you can just make notes. You don't have to get like a second inspection and add that.
No, I mean, if you want, you can have the inspector come back and say, yes, it's clear.
Oh, okay.
Yeah, not a big deal. She'll charge a few bucks to do it, but it's worth it.
Yeah.
And the buyer,
that full transparency.
Yeah, and a buyer can still get an inspection if they want, if they negotiate that with the seller.
Mm-hmm.
And it's probably not going to find anything else. But you never know.
It's just setting the sale up for success.
Exactly. You need to put a sleep at night with these transactions and not have this goofy stuff hanging out there. But between doing the inspections and disclosures and everything after you sign a contract and the price of the escrow companies, that the listing agents aren't looking out for your best interests of finding, the least expensive and high quality escrow company. They're just like the last deal I had. Oh, I've been using Susie for 30 years. That doesn't make her qualified.
Mm-hmm.
Of course, once we got under contract, we had a problem with Susie because they're doing it the old way. And, but when the seller is paying for the title and escrow, I can only fight so much to get it to the regular title companies with escrow, showing them the amount. I say to the agents, look at how much money the seller could save. You'll look like a hero. But no, they still do it. And they don't give you the disclosure that let's say the brokerage has an ownership interest in that title company that they referred you to until after you sign the agreement and then get the disclosures, which I think is a violation of some federal law, but I'm not sure, so don't quote me on that. But it's just awful.
Yeah, and you mentioned it was California. Now, in the other states that you're licensed in, are inspections required before the property goes to market?
No, it's not a requirement by law or anything.
No.
It's just like marketing the property.
Okay.
It's just properly marketing the property.
So in Washington, is it?
Okay, well, let me talk about Washington State a little bit because they're a little weird. Right in the contract, it says that the seller doesn't want to see the inspection report, only wants to see what we're complaining about, or you can send the full report. So nobody checks you can send the full report if they're a seller. They're going to check either don't send it to me or only send me the little bits, because then they only have to disclose the little bits.
I see.
Do you know what I mean? Or they don't have to disclose anything if they don't see anything.
Work out there in a closed envelope. They know it's been done. And the buyer's agents can see it, but the seller has no idea what the report contains.
Right. Nor the listing agent.
Or the
no
listing.
idea.
Yeah, that seems like a step back in transparency.
Hello. But nobody at the Washington State Realtor Association is bringing that up to the legislature to change. So it's not going to change anytime soon. So, and wait, if by accident it says don't send the report and we send the report, then the inspection contingency is over.
Oh.
Makes it even more ugly.
Oh, wow.
Yeah.
Now, the other state that you do a lot of business in is in Texas, and they've got their own laws or rules or regulations.
I'm not the broker in Texas, so I don't even want to say.
Oh, okay.
One of these days we'll get her on and she can explain.
Haley on.
Yeah, get Haley, explain all the weird stuff there. So.
Well, we had 3 topics here, and there is a common theme. If you want to know the secret, they all cover the same thing: transparency, flexibility, and documentation, whether it's crypto assets, alternative lending products, or disclosure law. The deals that survive are the ones built clean from the start. That's what I drew from that.
Amen. Exactly. So we keep saying it like a broken record, but get it done up front. You'll save yourself a lot of aggravation.
Absolutely. Well, this has been another episode of We Fixed Real Estate.